Hello and welcome to your mid-year investment outlook. Firstly, to introduce myself, my name's Carla Floyd and I am Head of Client Origination here at Coutts. And I am delighted to be joined in the room with Fahad Kamal, the Coutts Chief Investment Officer, and Imogen Bachra, who is Head of Economics and Market Strategy within our NatWest Markets business. So this week saw the publication of the Coutts Mid-Year Investment Outlook, which is always a really fantastic and interesting read. So thank you to the authors. And we want to take this time to sort of delve into and unpick some of the themes and key messages that have come through that. Before we go into it, a bit of housekeeping, if I may. First and foremost, you will see on your screen a QR code, which you can scan now and at any point through the today's discussion to see the full report to read at your leisure. You will have also have the opportunity to ask some questions. We do have some pre-submitted questions, but we always love to hear from you and the things that are on your mind. So do use the Q&A tab within the Zoom webinar status to add those in, and hopefully we will get to as many of those as possible through the time. And then finally, as you'll have heard before in these events, this doesn't constitute investment advice. It is accurate at the time of broadcast, but is obviously subject to change, which I actually think is a really good segue into where I really want to start today. You know, we know that the war in Iran and the closing of the Strait of Hormuz has had a real impact on markets and some of the sort of uncertainty that has built in, and we're actually getting very used to at the moment, but through the first half. And after a period of some stability overnight, we've seen some more news and some more disruption within the region. So Imogen, if I may, I'm going to come to you with my first question. But how has the UK managed and navigated that over the last few months?
Yeah, well, certainly from a markets perspective, it's been a very volatile period. The UK, like other markets, has experienced the same kind of shock from an inflation perspective, from a repricing of central bank policy perspective. From an economic perspective, I think you would argue that the UK so far has fared a little bit better than we might have thought just a couple of months ago, particularly at the beginning of the war. So we've seen an uptick in inflation, but it hasn't been particularly sizable. We've seen a slight rise in inflation expectations. We've seen a slight tick up in wage expectations in surveys, for example, but nothing particularly drastic or necessarily very worrying, I would say. But I think it's also important to note what we haven't seen in the UK from an economic perspective. And one of those things is we haven't really felt yet the full effect of those higher wholesale energy prices. We have in the UK an energy price cap that resets quarterly. So we haven't yet had a sort of quarter of data with a higher energy price cap as wholesale energy prices have risen, which means that we haven't felt the full effect of the higher energy prices, the higher oil prices as a result of the war. So although inflation has so far remained quite well behaved, we think there's probably more pressures to come, and particularly as we get sort of more disruption and potentially more volatility in the region. We also haven't seen a big de-anchoring of inflation expectations yet. That doesn't necessarily come, but certainly as we see these inflationary pressures materialize over the coming months, we might see inflation expectations rise a little bit more than we have seen to date. And then perhaps the final thing I would say, just from a sort of consumer and business perspective, is that we've seen a different elasticity of demand. So the way that consumers have behaved to this kind of higher wholesale energy price is different to what we saw just a couple of years ago in 2022. So what we're seeing is within the basket of goods that consumers are spending on, they are allocating more to other things and less to fuel. So perhaps they're finding other ways to travel to work, or they're just traveling less, they're filling up their cars less, which when we think about whether this could be an inflation shock or a growth shock lends itself more to the inflation side of the story, i.e. consumers have more disposable income to spend on other things rather than just spending a much larger share of their sort of disposable income on fuel, if you like. So we have seen, small economic disruption, I would say, but certainly nothing like the scale that we were considering at the beginning of the war, and certainly nothing like maybe the market was expecting in those early days when we saw significant volatility and significant market moves.
Brilliant. And I think that also plays a little bit to the resilience of the consumer as well, and actually how much we all and sort of generally the market has had to sort of endure and put up with over the kind of last, sort of 6-7 years. So one of the things that obviously inflation has a big impact on is the Bank of England policy. Mm-hmm. How do you see that inflation outlook and the points you just brought out playing into Bank of England decision making over the foreseeable?
Yeah, so the Bank of England are a inflation targeting central bank. They target inflation at 2%, which is sort of how they define price stability. Anyone that looks at this data closely will know that we haven't really got that close to meeting that target, or certainly not on a sustained basis, for a long time essentially since 2022 and that first energy cost shock after Russia's invasion of Ukraine. And so that is a problem when we think about how the Bank of England might respond to the current energy cost shock, because essentially the Bank of England, particularly compared to other central banks, and perhaps we'll go on to talk about that in a minute, but they are approaching this shock, if you like, with excess baggage. We still have a lot of domestically generated inflation pressures in the UK. Service price inflation is still well above levels that we would consider to be consistent with meeting that 2% target on a sustained basis. So it feels to us like the Bank of England might have to respond to that with higher or tighter monetary policy, so raising rates. We think that the evidence that they need to see in order to feel compelled to raise rates is still to come, i.e., like I was saying before, we haven't yet seen the full effect of the first round of this energy cost shock, let alone see, how persistent or the extent of second round effects, that kind of core inflation, how persistent that is going to be. And so they might not need to raise rates until the end of this year, the early part of next year, but we do think that they will have to respond with slightly tighter monetary policy.
Fab, and you mentioned it there in terms of how that compares to other central banks, and I feel like it's never been more in focus, some of those differences and similarities between, whether it be through politics, whether it be through growth outlook, etc. So talk us through, how does that divergence play through in central bank activity, so particularly the Fed and the ECB?
Yeah, it's a very similar shock. This is a sort of global shock, but for economies and for central banks, it will mean different things. Like I say, the Bank of England is approaching this with sort of excess baggage. They've got very high service price inflation still. Whereas you look at somewhere like the euro area, and actually since 2022, inflation has been much more contained. They've managed to get inflation back to 2% on a much more sustained basis. They've got rates. They managed to cut rates. The ECB did more than the Bank of England did, and arguably got back to a sort of neutral level. And they're on what I would consider to be weaker growth footing as well. So we have actually seen the ECB respond already with a rate hike that was designed, in their view, to sort of contain inflation expectations. But we think it's quite unlikely that they will need to raise rates again. A bit conditional on what happens in the Middle East, of course. The longer it persists, and if there are periods like we've seen overnight where the market becomes more concerned about oil prices and what that means for inflation expectations, that might change things. But as it stands, we don't expect the ECB to have to raise rates again. And then you have the Fed, who they have a different problem altogether, in the sense that they haven't managed to contain inflation. They have a similar inflation problem as the Bank of England does, but they've had growth and productivity gains alongside that. However, we see weakness coming further down the line on the growth side, and the Fed is slightly different in that they have a dual mandate. They target inflation and full employment, and they also have a new Fed chair, so he might respond differently to the inflation problem. So we think actually the Federal Reserve could be cutting rates, but that's probably more of a 2027 story. So I think central bank divergence could be quite a key theme for rates markets over the coming months.
Yeah, and I mean, not least of all, also thinking about the Fed and the political noise around that and the impact that can have, rather than, in addition to the dual mandate. So we've talked a bit about central bank policy and monetary policy and how that could play out in relation to inflation in particular. What other themes, thinking ahead to H2, what other themes do you think might dominate, or that we should have on our radar and our clients should have on their radar?
Well, certainly it's the kind of inflation impact. Like I say, we haven't felt the full effect of that yet, and we aren't clear on what the central bank reaction function is going to be. So that is really going to be a key theme for the second half of the year. Domestically, it would be remiss of us not to talk about the political backdrop. We're likely in the coming weeks to have a new Prime Minister. We think he will bring about a change from a policy perspective. We don't have a lot of detail yet on what his policy priorities are going to be, but it looks like there will be more spending for investment. He's sort of campaigning on a growth agenda again. So there'll be lots of uncertainty in the UK on how those investment spending plans will be funded, what that means from a markets perspective, and of course, more importantly, what that means from a growth and inflation perspective. And then there's a huge global angle. We can't ignore the geopolitics. We can't ignore the politics in the US. We've got midterms in just a couple of months. So there's really plenty of themes for us all to be focused on, I would say, in H2.
Perfect. And we will come back to the kind of political UK politics landscape a bit later. But Fahad, you've been sitting very quietly and politely, so thank you for that.
Unusual.
Yeah, well, you said it, not me. But some of the themes we just talked around then, it was, consumer resilience, but also we've seen market resilience to some of these geopolitical tensions, some of the uncertainty within the whole sort of global landscape. So tell us, what's really driving that market performance today and over the past 6 months?
Earnings. Simple as that, right? I mean, we live in a world where noise is incessant, constant, particularly over the last few years. That's just part of the world that we live in. And to some degree, you need to have a degree of cognitive dissonance, right? You need to put all of that noise, which is incredibly difficult to ignore, in a box, and you need to focus on the things that have high efficacy when it comes to investment decision making, which typically are, where are we in the macro cycle and what does that mean for earnings? And frankly, that is what we're doing when we're buying risk assets, particularly equities. We're buying an earnings stream for the future. And if we don't see a recession coming, then typically, all else being equal, it's wise to stay invested and stay long risk assets and ignore the noise, because as long as the macro cycle is fundamentally strong, it doesn't have to be super strong, as long as we're in an expansion or even a slowdown. Typically, companies tend to generate earnings and earnings growth. And that's ultimately what it is that we're trying. I mean, simplifying this down to its bare essence. That's it. Now, you asked about geopolitics, and the chart on the slide that we've got here is a useful case in point. Now, we have shown basically a version of this chart every call we've done for a long time. Because the noise is very loud, right? And the questions are obvious, right? How is it possible? How is it possible, right? That this has an effect. And ultimately, as I said, it comes down to earnings. Now, if you look at that chart, there's a few notable moments where there was a high degree of volatility, uncertainty. And by the way, human angst and all of that, I'm not at all downplaying or any of that. That we live in a world where there's a lot of pain, suffering, geopolitical tension, etc. But the right decision from an investment perspective is always to focus on the things that tend to have a high degree of efficacy over the long term. Geopolitics tends to have a very short, sharp, immediate, tends to, not always, and not, and this is not some crystal ball, but typically speaking, you have to put the geopolitics in the context of the macro cycle and the earnings, and to the degree that the former affects the latter, it matters to us. Yeah. But the right call over the last 3 years, frankly, particularly since we've been running the anchor and cycle investment process has been to focus on the macro. The macro has been positive, ignore the geopolitics. And as we see over the last 5 years, the market, and that's just chart of the S&P 500, but you could have used global equities, you could have used, frankly, a number of series over here. The point is, started at 100, you're well above 200 now. The last 5 years has seen a doubling in risk assets, and it's been through all the noise that, all the noise. And by the way, we could have littered that chart with 1,000 lines of noisy, geopolitics. But, just to emphasize the point that it's very, very important that we stay focused on those things that have a higher degree of efficacy, and that tends to be macro cycle and earnings.
Perfect. I think that's super clear in terms of the messaging. Now, we're 15 minutes in and we've not mentioned AI, which I think we've done well. But it's obviously a key theme in the investment outlook, and it is something that we don't go many days without thinking about it and answering questions on it, and thinking about both in our sort of personal and our professional, and of course our investment activity. So one of the key themes of AI of this year has been that capital investment. That's underpinning and really driving a lot of the market. So how do you think about that investment and taking in the earnings point that you've just made, and how it will support earnings growth over the short and medium term?
So, great question, and ultimately this is sort of the point. We talk about AI all the time. We're using it much more, than we ever have. Personal lives. I use ChatGPT for everything now. It's shocking. I can't think of a holiday now without using it, right? So, obviously we're using it personally on a corporate basis. We are obviously using AI. Much more than we have, and we're just scratching the surface. We know, especially from where sort of the leadership has a very clear intention that AI usage is going to be a bigger and bigger part of our lives, of our work, professional, how we do things, how we ultimately deliver for clients. Now, point of all of that is that because we're all using it much more personally, professionally, etc., it is generating earnings for those companies that are producing it. So the chart on the screen here is number one. Look at the earnings. Okay, so the blue bars on the screen show how much of the earnings from the U.S. market, for example. Once again, we could use this for a number of different markets, but given the U.S. market is the 900-pound gorilla, on the global stage, we use that. Plus, the data is quite good. IT earnings are, the blue bars tower above the green ones. The green is everything else, right? So you can see why, these sort of top 10 companies in the US, which tend to be connected to technology, AI, etc., whether they're producing chips, whether they are spending on chips, whether they are, ultimately the ones that are delivering the ChatGPTs or the Groks or the Claudes or whatever, they are the ones that are generating tremendous amount of earnings, right? Towering above every other sector. It's the hot thing. This is not obviously a new phenomenon. It's going on for a number of years. And we do see a broadening. So the blue bar is now less, sort of towering above the green one as it has sort of, a year ago or so. But nonetheless, that's the theme of the day, right? These companies are generating tremendous amounts of earnings, and that's why we are leaning towards them. The other point that you made regarding CapEx is also hugely important, right? So while the chart on the screen that you've got here is basically showing you sort of what the earnings per share is, for the market as a whole, but you can see that capital expenditures are becoming a larger and larger proportion of that. Now, all of that CapEx is going largely on chips. So if you think about why companies like Samsung or Micron or companies that or SK Hynix, people that hadn't heard, Nvidia even, these companies are basically the beneficiaries of this huge amount of spending that's happening from hyperscalers, which are effectively buying chips so we can do all the holiday planning that we want and what have you, and putting in long 70 page papers into the system and popping out nice, beautiful bullets. All of that stuff is basically represented on this chart over here. All of that capex is going to build, at the moment, huge amounts of data centers, chips, etc., in order to make that possible. Of course, the real end game isn't that. That's just where we happen to be in the cycle right now. We are, sort of very, very, very early stage, nascent foothills of this long mountain. Clearly, the companies that are spending all this capex, believe that the real end game is when all of this investment effectively goes into the wider economy and thereby making us all much more productive, right? And using these things, and that to the point that Imogen was making earlier, that is, really the thing that we expect and we hope, and all of our optimism is based on that. Ultimately, there's a huge ROI for these companies, but much more importantly, there's a huge generative productivity gain that is tangible, that leads to higher growth, and higher growth, in a nutshell, oversimplifying, but solves all of our problems.
Okay, so some clear themes within that, and you also referenced earlier the process and how you approach and think about your investment strategy. So you've spent most of this year overweight equities. You've reduced that risk.
I'm glad you said equities after overweight, but yeah.
Yeah, I'm not going to go there. You've reduced risk modestly over the past sort of couple of weeks, month. So talk us through that. What were the signals that led you to that decision, and how do you think about that sort of over the coming months? Do you see that position sort of retreating even further from that overweight equities?
So no, look, it's a great question, and effectively we have been overweight equities not just this year, but for the last 3 years. Okay, unequivocally. Now, the difference is a nuanced one, but it's the degree that we've been overweight. Sometimes sort of quite a big overweight, sometimes less so. And and that, by the way, has been the right call over the last 3 years. We have been in a bull market. It's not been obviously in a straight line. There's been volatility, choppiness, but we've been in a bull market for 3 years, and we have leaned into that on behalf of our clients. And our publicly listed funds are all sort of 90% plus of our clients who have been invested continuously with us for the last 3 years have had double-digit returns net of all fees, right? So that is sort of but it's because we've been leaning into risk assets at a time when risk assets have performed really well. The degree has changed. We started this year sort of with a larger overweight, and very recently we've brought that down. Now, why, right? Ultimately, it comes down to, once again, we look at our process. There's a whole host of things that we look at. Where we are in the macro cycle is still in expansion, so that's good. But what's changed is the and Imogen very neatly described this, is at least for the foreseeable future, the next few quarters, we think that there is clearly a higher inflation sort of impetus in the system, and as a result, the monetary policy paradigm is going to lean towards being more tight than being loose, right? And for example, very simply put, we started this year with everybody expecting rate cuts. Typically, that's a tailwind for risk assets. Suddenly, we've come into a paradigm where the market's expecting rate hikes, and it's expected them quite quickly, right? Largely as a result of the energy shock in the Middle East, which is not over. And but as a result of that, monetary policy expectations have tightened. On its own, that is not a reason to cut risk or to go to go negative, to go underweight risk assets or anything like that. But at the margin, clearly what was a tailwind is now a headwind, and therefore we thought it was prudent to cut our risk position slightly and to be in a more still in a risk on, but in a less risk on stance than we were 2 months ago.
Perfect. And I think, you sort of lightly referenced there in a very modest way, but some of the fund performance, etc., which has been outstanding, but probably the right moment for me just to reiterate that obviously the value of investments and income can go up and down, and you might not get back what you put in. So it's a healthy time to remind all of our clients of that. But so we're thinking about that risk sentiment. We're thinking around the anchor and cycle process. Emerging markets, That's been another feature of the investment philosophy and approach over the last few months. It's also been something which I think links quite neatly into the reference you made earlier of semiconductors and AI. Do you want to give us a bit more insight into your emerging markets thinking?
Yeah, so at the very headline level, we've cut risk, but underneath the surface, we've actually sort of largely cut that risk from the US and from the US and increased our risk exposures to emerging market equities. Now, the emerging market equities space has also dramatically changed from what it was 10 years ago, right? 10 years ago, it would have been a lot of large oil and gas producers, banks, etc. Today, it is largely an AI play, frankly, right? The emerging markets, whether it's Taiwan, South Korea, I mean, these are the big dominant countries in the emerging markets index, and they are dominant because they are effectively, semiconductors and chip manufacturers. Now, we have increased that, and by the way, it's been a great place for us to have been. Emerging markets have been on an incredible run, volatile, choppy, but they have been on an incredible run. And one of the reasons why we've been able to generate that performance for our clients is that we have had a very, very healthy exposure to that complex. Now, we expect that to continue, largely because of what you see on the chart over here. Now, this is somewhat of a complex chart, but for the geeks out there, effectively, what this is showing is the correlation between hyperscaler expenditure, CapEx, which we already showed in a previous chart, which is just going up, and we don't expect that to come down anytime soon. It could. So this is not at all a crystal ball moment, but for the moment, there seems to be a huge amount of momentum in CapEx increasing rather than decreasing. And clearly, companies that produce, and that CapEx is going on chips, and companies that produce those chips are doing well. So a lot of what the emerging market complex, that recent run has been based on, is simply the fact that these hyperscalers, which are the four big sort of US companies that produce all the, the apps that we love, they're going to keep spending on these things, and companies in the emerging markets are going to keep benefiting from them. That's what this chart on the screen shows us here, and we expect that to continue for the foreseeable future, which is why we have had an overweight to that complex in particular. But yes, while we've cut equities, I guess the nuance is that we've actually increased our exposure to emerging markets because A, we expect this to continue, and two, they've got a very nice confluence of price appreciation and earnings appreciation, something that we like. We don't like one without the other.
Brilliant, loud and clear. So, final question for now. Diversification. That's something that we often talk about in terms of both from a kind of how we manage our money, but also particularly around the investment approach and the importance of diversification. So we've spent a lot of time thinking about equities over the last sort of 5-10 minutes. What about bonds, golds, alternatives? How do they play into your investment approach?
Great question, and risk management and downside protection is paramount to us, right? I mean, genuine, and people say this, but it's true. We are very, very, very cognizant of that because we know that our clients are very sensitive to loss. It's sort of obvious, right? So we try to construct our portfolios with a very, very keen sense of how much loss can our clients tolerate, what is a sensible amount of loss that we should expect, and how is it that we want to construct our portfolios that are resilient to all sorts of things that nobody can see coming, whether it's a geopolitical stress event or a market stress event or whatever, right? Stresses are inevitable. The nature of them is unknown. So in that, with that in mind, we are trying to build portfolios that are generally resilient against a range of shocks. Now, in the old days, that was pretty easy, right? So if you look at the chart on the screen here, from 2008 to 2020, typically when you had an equity sell-off, the bond yield went down, which is what that line is showing you over there. Effectively, what that means is when the bond yield went down, the bond price of bonds went up, and it would hedge you against your risk quite neatly, quite beautifully, and that is the basis of the old 60-40 sort of portfolio. As you can see that since 2020, that has not been the case. Bond yields typically have gone up when you've had huge stress, which is not ideal, all right? So So as a result of that, we've had to be much more thoughtful about how we construct portfolios and to make sure that we are still able to provide that downside risk. And the chart that you see on the screen now basically shows you a variety of different assets that perform differently depending on the nature of the shock. Now, we have a large position in liquid alternatives that did very well over the last few shocks. It held its value, etc., and has typically, when you're not in a shock period, typically tends to provide you a nice return. Gold, did really well in the March 25 shock. Didn't do so well in the May 25 shock. There's no way to know that in advance. Right? With the benefit of hindsight, we know that this particular shock hit a lot of central banks in the Middle East particularly hard. As their oil revenues were drying up, they sold a lot of their gold assets. It was all lovely and makes sense in hindsight, but nobody knows that in real time, which is exactly the purpose of this chart, is that we have constructed our portfolios using some gold, some liquid alternatives, and in order to diversify from some of the bond risk. But before I go, I just want to show shock. This doesn't mean that we don't like bonds, right? And bonds are still a very, very large part and still form the basis of our defensive holdings. And one thing has changed quite dramatically, especially over the last 5 years, and that is, if you think about since in 2020, bond yields were very, very low, so they weren't providing you much income. And on top of that, when you had the shock and bond yields went up, that really hurt you on the price. But today we're in a totally different world, right? So today, the what you see over here is that 10-year yield. This is the U.S. I believe, but basically you've got a yield of call it 4.5%, okay, which is great. Now, off that 4.5%. Half of that is basically inflation expectations. The other half is a real yield, right? So you actually are getting paid reasonably well while you're getting some defensive protection. We don't think it's perfect in every environment. It's not going to, and as Imogen has said, who knows what happens with monetary policy and what rates might go up, they might go down, etc. So we're just less. It's not the only answer anymore. That's why we have a few other things. But having said that, we still think that the income yield that you get from bonds today is adequate, and they provide some reasonable amount of protection. Nonetheless, they are more volatile.
Brilliant, thank you. So we've spent quite a lot of time thinking around the markets and the investments and some of the decisions you've made and will continue to think about into H2. But I said earlier, and you referenced to Imogen, around some of the changes in the UK government. Now, for all the things that are uncertain, two elements of what feel like both entirely certain and likely certain are around we will get our 7th new Prime Minister in the last 10 years, and secondly, that it's likely to be Andy Burnham. Yes. So tell us, what are the things you're looking out for, and what are the things that you think will impact from sort of bringing that back into the UK economy?
Yeah, so there's, I guess, when we think about it very high level, the two things that we're looking out for are what are his policy priorities and what is that going to mean for growth on a very near, medium and perhaps longer term horizon, and how are those policy priorities being funded? So, like I said earlier, we don't have a huge amount of policy detail yet. Of course, we don't know who the Prime Minister is going to be. Nominations only opened this week for the Parliamentary Labour Party candidates to kind of throw their hat into the ring and get the MPs backing. So we're still very much in the early days of this potential leadership contest, potentially not, but it does look quite likely, we think, that it is going to be Andy Burnham. So we have been focused on what he's been saying. He gave a couple of keynote speeches last week and delivered his first interview since he was elected MP for Makefield. So we can have although we don't have kind of specific policy detail or policy costings, we've got a bit of an idea of what his priorities are going to be. He's talked a lot about infrastructure spending, he's talked about housing commitments, and he's talked, of course, about regional growth and that devolution powers as well. He's also talked a lot about the manifesto commitments for the current government. So, one of the ways in which he might offset some of his spending priorities is, of course, via higher taxes. He has, at this stage, ruled out, similarly to what Keir Starmer and Rachel Reeves ruled out in terms of tax rises, which means there's other options. There's lots of talk in the press about wealth taxes and things like that. There are levers that he can pull, but one of the things, particularly from a market's perspective, perspective that I am focused on is just how much more borrowing he might need to do to fund a lot of these policy priorities. And so far, he's talked a lot about fiscal discipline. He's even reassured the market that he won't deviate from the current fiscal rules. But I'm perhaps a bit more worried than most that actually over the coming months and even over the coming years, once the kind of fiscal backdrop becomes more evident, once it becomes clearer that it's very difficult to spend over here, not raise taxes and not borrow more, that he is going to have to start playing around with those fiscal rules at the margin. I think that he'll be looking at the investment spend in particular. Lots of the advisors that he's got on board, Jim O'Neill in particular, has talked a lot about the need for looking at more ways that they can use the space within the current fiscal rules to invest more. So I think that that's the first place that they will look. There's of course big defence spending commitments that are likely to be accelerated and come under increasing pressure given the geopolitical backdrop over the coming months. But it really, to me, comes down to what he's going to do on the fiscal policy side and how his policy agenda and his policy priorities are going to be funded. And then just quickly on the growth side, a lot of what he's talking about is really about investing for the longer term. So it's possible that this is the sort of boost to growth that the UK economy has been looking for. But it's likely to bring growth only on a very much longer time horizon. And that's one of the ways I think he might look at the fiscal rules, is how can they apply over a longer time horizon? Because that's only when we might start to see the impact of his investment policies. And of course we have the borrowing impact, going back to Fahad's point around bond yields and the types of returns they offer. If we are to see more borrowing, that can push up government bond yields. And that too has a knock-on effect on the UK economy. One of the reasons why we've been in this although it's been more resilient than we might have expected, UK growth has still been quite sluggish. And one of those factors is because we've had what we would describe as a kind of crowding out of the private sector. The public sector, the state has grown, it's been borrowing ever more on the markets, pushing up those borrowing costs for itself, but also for the private sector as well. And so where we look at that chart for US companies and we see ever increasing capex, actually on the UK side, that chart would look quite different. We haven't seen that kind of capital expenditure. We've seen an erosion of the capital stock, and we've really seen this crowding out of private sector investment in the UK. And so, more public spending, more public borrowing, there's a potential that could help support the UK growth over a longer time horizon, but it's not without risk and risk of what that means for the private sector as well.
Brilliant, thank you. And there was lots in there that I want to unpick, but I'm also very conscious that I offered the opportunity to answer some of your questions, so I should probably not hog the mic any further. Question that's just come in around, and I think it goes to one of the charts that we had up earlier on the return in gold, and you talked about March 2025 and how that was a great time for gold and less so of the recent market movements. Is now a good time to invest in gold?
So I don't know. Okay, I have no idea where the price of gold is going to be tomorrow, right? I mean, if that's the nature of the question. Now,
and you probably wouldn't be sat here if you
exactly, exactly. But the important thing about it is now, and this is, I guess, the key point, is that is it a sensible allocation at present as part of your diversifiers within a multi-asset context? And the answer to that is unequivocally yes, because of the chart that's on the screen right now. And I don't know if we can replay that, but effectively, it just tells you, right, that not every time and not everything works every time, but gold has a very long history of having defensive characteristics when you need them most, against geopolitical shocks, but also against debasement issues. Imogen sort of alluded to the fact that if we just have runaway sort of deficit spending or something like that, real assets like gold tend to hold their value because the regular currency becomes debased and what have you. Not that we think that's going to happen. I'm just saying that it is a hedge against all sorts of things. So as part of a wider multi-asset portfolio, does it make sense to have some allocation to it? Yes. To the exact number that it might end the year at, we know nobody can tell you, but we hold it, a small position, because we think that it adds portfolio ballast.
Brilliant. And I guess moving to the next question here, which is a really interesting one, and I think actually with both of you here, if you could give the view of a private client, and perhaps Imogen, you can touch upon some of the institutional investors that you speak to, because I know you're both with clients day in, day out. What is the biggest misconception that investors have right now? Imogen, why don't you go first?
Perfect. Yep. I mean, it just goes back to what we were talking about around the UK politics. Can I give two answers, actually?
No, not got long though.
Domestically, I think it comes back to UK politics. You know, there's this real sense that Andy Burnham, if he is Prime Minister, he isn't going to borrow more. He's going to stick to the fiscal rules. There's a big presumption, I would say, in UK markets that because of 2022, politicians have sort of learnt where that red line is in terms of what the markets will allow. And my personal view, the view of rate strategy at NatWest Markets, is that actually that's not the case. Liz Truss learnt where that red line was, but each subsequent politician has to kind of test that for themselves. And in fact, we saw that with Rachel Reeves and Keir Starmer. You know, if we were sat here in 2024, we would have been having a very similar discussion. The market was very relaxed about a shift from a centre-right to a centre-left government. It was very much, oh, there's no room within the fiscal rules to borrow more. The market won't allow them to borrow more, and therefore they won't. But actually that wasn't the case. You know, it only took a few months, their first fiscal event in the autumn, and they increased borrowing significantly, and borrowing has increased, you know, sort of ever since then. So I worry that the market is a little bit complacent around the risks to higher borrowing from this potential change in leader. And the second point, which maybe feels a little bit obvious given the backdrop with which we're recording it today, but I do think the market has been a bit complacent around the risks that still exist in the Middle East. You know, we saw a sharp rise in oil prices, and they've recovered very quickly since it became, you know, evident that the path was towards a kind of signing of the deal. And actually we've got back pretty much to pre-war levels. I would argue that that reflects a degree of optimism that isn't necessarily reflected in what we see in terms of kind of physical flows through the Strait of Hormuz. You know, there's not much shipping at all that's happening. Shipping costs remain very elevated. Shipping insurance costs remain very elevated. And there's still plenty of inflation in the pipeline to come, I think, because of the disruption over the last couple of months, which, you know, as we record today, it's evident that disruption is not over. So I think that oil prices reflect a sort of degree of optimism, which is perhaps not what's reflected in reality in the Middle East.
Brilliant. Anything to add?
I think that's really well said. All I would just sort of add to that is that, look, you know, we speak to clients all the time that, like normal people, you know, sort of worry about what's on the front page of the paper, etc. And all of that is very and by the way, it affects all of us, right? We all live in a world is full of, you know, unpleasant things and, you know, etc. So that's fine. But I guess, you know, the misconception is that, you know, what is your time horizon? What is it that you're trying to do? And once you answer those two questions, typically speaking, what's on the front page of the paper is not what you should necessarily be worried about. You should be ruthlessly focused on where you are in the macro cycle, what that is likely to tell you about earnings over the next 18 months, 24 months, 36 months, etc. And sort of navigate your investments through that lens is the only thing I'd add. But yeah, you know, it's been a real pleasure actually to share this. Yeah.
So I think we've got time for one more question. And I wanted to bring in, and I see we've had plenty, so thank you for everyone who sent them in. Crypto. That is something that doesn't go away, but obviously sort of to some degree feels like it comes in and out of vogue and what people are thinking about and talking about. Is now the right time for cryptocurrency to become part of your diversification play? And how are you thinking about that at the moment, Fahad?
The answer is no. The reason is because unlike, so a lot of people say, well, it's just digital gold. So if you have gold, why don't you have that? And the big difference is that gold has a more reliable behavior when a crisis happens, etc. Right? And it has done so for thousands of years. Crypto is very new. Doesn't mean that it can't behave like that. But as we can see over the last few cycles, last few sell-offs, last few bouts of volatility, it's not really been a protection. It's not really been much of anything. It doesn't really have any real, fundamentals by which we can understand it. And that's the big difference between gold. If and when it becomes more of a reliable hedge or source of return or what have you, we'll consider it. But it's neither of those things, so we don't.
Perfect, thank you. I think for all of the uncertainty and the other bits that we've talked to today, that is something that feels like a very unequivocal view, which is super helpful. So look, with that, 45 minutes has whizzed by. So I kind of just wanted to take the opportunity to talk to some of the key takeaways from my perspective, which I would summarise in 3 things. The first one being the resilience. Resilience is a word that I think is really played into a heck of a lot of what we do over the past decade, is it really? But it's the markets have been more resilient than we expected, and that despite the likely or sort of what we've seen from that uncertainty and the tensions, both geopolitically and indeed within the markets, that feels like something that it's going to remain, and we're going to be looking out for the data. Whether that be earnings, whether that be inflation, and thinking through that lens rather than perhaps some of the noise. The second one is we remain constructive to those data points, and Fahad, you talked about it really super clearly earlier, but we are more measured. So we think around, we continue to favour equities over bonds. We have modestly reduced risk, but we are still risk on. And we're also thinking about the role of AI within that risk view, but very much going back to our anchor and cycle process. And finally, diversification. It is something that continues to be critical and will continue to play a really important role, whether it be bonds, whether it be gold, not crypto, alternatives. It's really important to align that diversification with our risk views. So just to wrap, just a reminder that today's conversation didn't constitute investment advice, accurate at the time of recording, and obviously subject to change, as some of this will have just over the last 24 hours with continued tensions in the Middle East. And that the value of investments will go up as well as down, and you may not get back what you put in. But finally, to wrap, thank you very much, Fahad and Imogen. I've certainly learnt a lot and got many food for thought for today. And if you have any questions and we haven't been able to get to them today, please do follow up with any one of us, but also with your banker. And with that, I will close. Thanks for joining.